At $13.65, down 11 cents or 0.80% on the intraday chart, Ford Motor Company is currently painting a deceptive picture on the tape. If you were just glancing at your Fidelity mobile app or checking the quick quote on your watch, you might see that red percentage and assume it is just another sluggish day for a legacy automaker. You would be dead wrong. What is actually happening right under the surface of this price action is one of the most aggressive strategic pivots we have seen in the industrial sector in decades, and the market's reaction, holding firm near 52-week highs despite massive headline shockers, tells you that the smart money is positioning for something the retail crowd hasn't fully digested yet. The expectation right now, the narrative that you will hear if you browse through casual forums or listen to surface-level commentary, is that Ford is in trouble because of the electric vehicle slowdown. People see headlines about canceled models and billions in charges and assume the company is retreating. That is the expectation, a dinosaur stepping back into the tar pit. But the reality is radically different. Ford isn't retreating. They are effectively weaponizing their manufacturing capacity to attack two of the most profitable sectors in the economy right now: hybrid vehicles and, surprisingly, data center energy storage. That $13.65 level isn't a ceiling, it is a consolidation zone where the market is digesting the fact that Ford just raised its full-year profitability guidance in the face of a $19 billion write-down. That is the tension we need to unpack today. When you look at the intraday movement, that drop of 0.8% is practically noise. We are seeing the stock oscillate between 1343 and 1381, a tightening range that often precedes a breakout. If you pull up the charts on Interactive Brokers, specifically looking at the volume profile, you will notice that the selling pressure on these dips is being absorbed incredibly quickly. This isn't panic selling, this is rotation. We are seeing a shift where growth-focused capital, the kind that usually chases Tesla stock or Nvidia stock, is starting to look at Ford not as a car company, but as a capital-efficient energy play. It sounds crazy until you look at the new business unit they just announced, which we will get to in a moment. Let's talk about the elephant in the room, the massive $19.5 billion charge Ford is taking. In any normal context, a company announcing a write-down of that magnitude would see its stock crater 10 or 15% instantly. Why is Ford sitting comfortably at $13.65? Because that charge is the cost of clarity. Ford is canceling the Me Too electric three-row SUVs that nobody wanted to buy and is instead doubling down on what is actually flying off the dealer lots: hybrids. If you've been tracking the auto sector through Schwab Intelligent Portfolios or reading the analyst notes available on Fidelity, you know that the hybrid market is absolutely exploding while pure EV demand softens. By taking this charge now, Ford is effectively cleaning up its balance sheet and admitting that the old strategy was wrong. The market loves honesty, but it loves profitability even more, and that is where the surprise comes in. Despite this massive accounting hit, Ford raised its adjusted EBIT guidance for 2025 to $7 billion. That is the signal. They are burning the furniture to heat the house, and the house is getting very, very warm. This brings us to the trading psychology of the moment. Retail traders on Robinhood might see the billions in losses headline and sell, fearing a dividend cut or further downside. We see this sentiment in the Robinhood stock trading forums, where users are nervous about legacy auto. But if you look at the institutional flows, the big block trades happening on the dark pools, they are buying. They understand that Ford is trading the uncertain future of pure EVs for the guaranteed cash flow of hybrids. It's a move from speculation to execution. When you compare this to SoFi investing strategies that often lean towards high-growth, high-risk tech, Ford represents a counter-cyclical bet. It's a value stock that is suddenly acting with the agility of a momentum trade. Now, I want to talk about the most overlooked aspect of Ford's recent news, something that links them directly to the AI boom. Yes, I said AI. Ford is launching a battery energy storage business. They're taking those battery plants in Kentucky and Michigan that were supposed to build batteries for electric trucks that aren't selling, and they are repurposing them to build storage systems for data centers. Think about the energy demands of artificial intelligence right now. We constantly talk about NVIDIA stock and the demand for chips, but those chips need massive amounts of reliable power. Data centers are desperate for battery backups. Ford has the factories, the supply chains, and the lithium iron phosphate technology ready to go. By pivoting these assets to serve the grid and data centers, Ford is essentially turning a liability into a high-margin asset. This is why you need to look beyond the car sales. If you are using Fidelity Wealth Management Services, your advisor is likely looking at this and seeing an infrastructure play disguised as an automaker. Let's get technical for a minute. The price of $13.65 is critical because it sits right above the 50-day moving average. If you use the advanced charting tools on Thinkorswim or Interactive Brokers trading platform, you will see a clear support shelf forming around $12.80. As long as the stock holds above that level, the bullish thesis remains intact. The resistance is sitting at $14, which is the 52-week high. We have tested that level multiple times in the last few weeks. Every time we hit 14, we pull back, but the pullbacks are getting shallower. This is a classic ascending triangle pattern. The market is coiling. If we get a catalyst, perhaps a positive monthly sales report or more details on the data center contracts, we could see a breakout that pushes the stock towards $15 or $16 very quickly. However, we have to address the skepticism. It's easy to sit here and praise the pivot, but executing it is a different beast. Ford has a history of quality control issues. You can't ignore the recalls. If you are a long-time holder, maybe you have your shares in a Fidelity brokerage account or a Vanguard fund, you've been burned before by promises of restructuring. The Ford Pro commercial division is a cash cow, yes, but the Model E electric division has been bleeding money. The concern is that even with this pivot, they are still behind Tesla stock in terms of software and behind Toyota in terms of hybrid reputation. That is the bear case. The bears argue that Ford is reactive, not proactive, that they are only switching to hybrids because they failed at EVs. And there is truth to that. But in the stock market, being a fast follower can often be more profitable than being a pioneer who takes all the arrows. Comment below how many shares of Ford you currently hold, or if you sold them recently. I am genuinely curious to see if the retail sentiment matches the institutional buying we are seeing on the tape. Are you holding through this transition, or did the $19 billion charge scare you off? Let's broaden the scope to the macro environment. We are sitting in a period where interest rates are a major headwind for auto loans. When rates are high, people buy fewer cars, or they buy cheaper cars. This creates a terrifying environment for companies that only sell $50,000 electric SUVs. This is where Ford's freedom of choice strategy actually provides a defensive moat. If a customer walks onto a lot and can't afford the financing on the Lightning, Ford can sell them a Maverick hybrid for half the price. Tesla doesn't have that flexibility. They have to cut prices to compete, which destroys their margins. Ford creates a tiered system that captures customers at different economic levels. If you are managing your own individual brokerage account, you have to look at how resilient a company is to recessionary pressures. Ford's ability to flex between gas, hybrid, and commercial vehicles gives it a durability that pure-play EV stocks lack. We also need to discuss the dividend. At $13.65, Ford is yielding around 5.5%. That's massive. In a world where you might get 4 or 5% in a money market fund or through Fidelity Cash Management, getting that same yield from an equity that has capital appreciation upside is very attractive. For income investors, specifically those using Schwab Intelligent Portfolios for dividend harvesting or those with Fidelity IRAs, Ford has become a staple. The question always looms, is the dividend safe? With the guidance raised to $7 billion in EBIT, the answer appears to be a resounding yes. The cash flow is there. The blue division, gas cars, and the pro division, trucks and vans, are printing money fast enough to cover the dividend and the losses from the EV transition. This is the financial engine that keeps the stock specifically buoyant above $13. Furthermore, we should look at the competitive landscape through the lens of the online investing crowd. Platforms like SoFi and Robinhood often gamify trading, leading to surges in stocks that have story appeal. Ford hasn't had a story for a long time. It was just Grandpa's car company. But this pivot to energy storage and the hybrid dominance is starting to create a new narrative. We are seeing an uptick in mentions on social arbitrage trackers. It's not at the level of GameStop or AMC, obviously, but there is a growing recognition that Ford is undervalued relative to its potential free cash flow. When you look at the price-to-earnings ratio compared to the broader industrial